Welcome to this course on momentum trading and Forex markets. In this course, you will learn about terms used in Forex markets, and factors that affect this market. You will learn the theory of momentum trading and how to use it in a Forex trading strategy. You will learn to code a trading strategy in Python using these quantitative techniques. You will also get exposed to a few important concepts related to risk management in the final section. If you are already familiar with Forex markets, you may start with Section 2 directly and come back to Section 1, in case required. If you are new or already using quantitative techniques in Forex markets, this course would be a great learning avenue to introduce you to new trading styles. So let us start. In this video we will understand the basics of Forex trading. The word Forex is short for foreign exchange. Before 1944, all the world currencies were pegged to gold. In other words, the currency could be exchanged for gold directly. In 1944, through the Bretton Woods Agreement, the US dollar became the world's reserve currency. As per this agreement, all the currencies were pegged to dollar and the dollar in turn was pegged to the gold. This was known as the gold standard. In 1971, following an alarming outflow of gold reserves, the US abandoned the gold standard and the world's currencies were no longer pegged to any tangible asset. This phenomenon of not pegging a currency either directly or indirectly to any precious metal is known as the floating currency. To determine the relative value of the currencies in a floating system, foreign exchange markets were established. The Forex market currently has a volume of more than $5 trillion per day. This is one of the most matured and actively traded markets in the world, with participants such as retail traders, brokers, investment banks, large corporations, and market makers. In Forex market, the value of a currency is determined relative to another. A few of the currency pairs are listed here. There are four important terms in the Forex market. They are the quote, the spread, a pip, and the leverage. Now, we will discuss each of these in detail. The quote. A quote is the price the market participants are willing to offer for a particular currency pair. For example, take the pound sterling to US dollar pair. Here, GBP is called the base currency, while USD is called the quote currency. The value of base currency is 1 and value as quote currency is represented in quote. Let us say that the current quote for pound sterling to US dollar is 1.5143, 1.5150. 1.5143 is the bid price for 1 pound here. That means, if you want to sell 1 pound in exchange for USD, you will find buyers at 1.5143. 1.5150 is the ask price for 1 pound here. Sometimes the quote can consist of a single price. In that case, it would represent the last traded price for that currency pair. The spread in a Forex market refers to the difference between the ask price and the bid price of a quote. Usually, a highly liquid market with many participants will have tighter or smaller spreads. Conversely, the illiquid markets will have a wider or bigger spreads. This happens because of the lesser competition amongst the traders, and the liquidity risk premium in an illiquid market. A pip. Most major currencies, except the Japanese yen, are traditionally priced to 4 decimal places, and a pip is defined as the 1 unit of the 4th decimal point. For dollar-based currencies this is to 1/100th of a cent. The change in quote is usually given by the movement in pips. For instance, here the GBP-USD pair has moved by 101 pips. For pairs with the JPY, Japanese yen, as the quote currency, a pip is 0.01 yen. Beyond the pip, it is possible that you might get an electronic quote, for a currency pair showing a value of the 5th decimal point, say 1.14583. This extra value in the 5th decimal, in this case 3, is considered as the value beyond the pip. The leverage. In Forex trading, traders use leverage to trade a currency pair. The leverage that is achievable in the Forex market is one of the highest that traders can obtain. Let us say that if you want to trade $100,000 worth currency, with a margin of 1% or sometimes written as 100 to 1, then you will have to deposit only $1,000 into your account. Leverage of this magnitude is significantly larger than the 20 to 1 leverage offered for gold and major indices, 10 to 1 leverage offered for commodities other than gold and non-major equity indices, and a 5 to 1 leverage offered for individual equities. Now that we have a basic understanding of the Forex market, in the next video we will learn about the impact of macroeconomic factors on the Forex market.